Well, good morning and welcome to the Spheria webinar. My name's Mark Cormack from Pinnacle Investment. Pinnacle are equity partners and works alongside the Spheria team to distribute the Spheria Small, Microcap and the Spheria Opportunities Fund to the Australian financial advisory marketplace. And today I'm delighted to be joined by the founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker, who are going to provide their insights on the recent February reporting season. We're also going to cover off on how the market's been responding to the fast-changing events with coronavirus. We'll cover off how portfolios are positioned and provide an outlook for the rest of 2020. In brief, Spheria are an independent fund management boutique who specialise in small, micro and mid-cap investing. You can access Spheria's funds via their unlisted managed funds or via the Spheria Emerging Companies Fund, which is a listed investment company with the ASX ticker code SEC. So what does Spheria do differently and in terms of how do they invest? Well, firstly, they focus on businesses that generate strong cash flows with low or no debt and strong balance sheets. And this is different from a lot of fund managers who can be held hostage to a style, and it means that Spheria can be both growth and value. Before we kick off, a couple of housekeeping items. Today's webinar will last around 10 to 15 minutes, and we'll have a Q&A session where all attendees have the opportunity to ask questions via the questions box on your screen. So without further ado, I'll hand you over to the portfolio managers, Marcus Burns and Matt Booker, to take you through today's presentation.
Thank you, Mark. It's been interesting times, obviously, with COVID-19 and the impact of that on the economy and the share market. It has obviously been quite harsh in the short term. For us, it has been, we're trying to be business as usual. We've done over 100 company meetings during reporting season. That's the focus for us. We are bottom up. However, we don't want to be complacent. So it is a big macro factor at play at the moment. And if you look at this chart, you can see how the coronavirus has developed in China and in Hubei in particular, where you can see the cases are actually declining quite precipitously, new cases that is. And you can see how it's been well contained outside of China as well. Obviously, the premise there is that we take the statistics at face value. Obviously, you can see the impact that's having on the rest of the world. So case estimates are rising at the moment, and that is impacting the economies globally, and that is obviously impacting the share market. We are hoping this will be a short to medium term issue, and it is actually providing significant opportunities to buy companies for the long term at relatively good valuations. So China seems to be having an impact in terms of containing it. The spread elsewhere is obviously going to rise. We're all aware of that. The media is all over it. Social and obviously the traditional media outlets are all over it. We actually see the Chinese economy picking up. So we've had a number of companies come through here that source product out of China. So they've got manufacturing over there. We had one in yesterday, and they said that 90% of their factories are up and going. So those processes are up and going now. The issue now could be just bottlenecks in freight, shipping and transport and the cost of shipping. However, we actually believe that the sort of lubricants back in the system and the factories are up and going. So there could be some slowdown in the economy in Europe and potentially North America, but at least the manufacturing base is up and ready to go. And when demand does pick up, that demand will have the supply to meet that demand. So we are quite positive on China and the prospects there for a big pickup. The Chinese economy is very strong. They will probably look to significant stimulus, and that could drive a lot of interest and demand in the commodity type sectors. So we are positioned for that as well. I'll just pass on to Marcus. You want to talk about mortality rates for a bit?
So on the next slide, obviously we put together some data here just showing where the most impacted parts of the economy are. Frankly, it's generally people who are 70 plus. We don't want to belittle the impact that it could have on people's health or the impact socially it has on countries and the fabric of the community. We obviously realise that's a very important short and medium-term issue. But looking at the economic impacts, it does tend to skew towards older people. And obviously people are cutting back aggressively on sort of short-term things like travel. So our view is that basically travel and short-term issues, short-term things like travel, hospitality, entertainment can be fairly impacted as people don't gather socially for a period of time. And all the recommendations are basically to segregate people to try and reduce the spread. Our view has been, look, as Matt flagged earlier on, our process from day one has been designed to sort of ideally to handle these kind of crises. We like companies with strong balance sheets for this very reason, that there's going to be periods in the market where the market turns off. We like companies with great cash flows, and we obviously like valuations which tend to trade better through tough environments. So, we're looking at, Matt and I kind of believe at the moment this is going to be a fairly short-lived demand destruction opportunity. Businesses that are very leveraged are likely to be more impacted than businesses that have got good balance sheets. So we typically try to avoid those anyway as part of our investment process. But if some of those names get very aggressively sold off and trade at big discounts and yet will survive, they may present opportunities for us to rotate into and create value for investors on the way out of that process. So I guess in short, we're taking the opportunity to look at our current holdings. Where we see risk, we've reduced. But generally speaking, we don't think we're massively exposed to probably the most prone areas of the economy. But on the other side, if there are good opportunities, we might look to rotate the fund into stocks that get aggressively oversold. If we think there's a margin of safety there and good upside, if the economy trades through this, which we think is very likely in the medium term. We also wanted to sort of gently address the results season we've just gone through. Obviously, February was a challenging market for months as a couple of things happened. The market was getting its head around the coronavirus and the impacts on the economy. There was an aggressive flocking towards defensive names and gold generally. The gold price rallied a bit over the month, and so you saw a very strong performance there from a number of gold producers. You can see at the top of this is the TSR, the total shareholder return over the month of February. So West African Gold, Bellevue Gold, top of the chart there, and obviously Fisher & Paykel Healthcare, which had good numbers, had a very strong performance. Equally at the bottom of the performance chart there, you can see that it's generally been some of the more sort of leveraged names or names that really struggled. So there are a number of profit downgrades that caused very aggressive derating in the share prices. That typically was with businesses that had operational and financial gearing, which sort of magnified the impact of the share price. And we started to, we've talked previously about the WAC stocks, they're very popular fintech stocks that have extremely high valuations. They've started to actually come undone a bit as well. And we've observed that stocks that don't have a cash flow backing or stocks that are reliant on the market being open to raise further funding either via debt markets or equity markets are starting to come under a fair bit of pressure as well. So the market was down fairly strongly in February. We do think that there's starting to become some interesting opportunities as the market starts to, the first reaction from the market when there's a shock is to sell off everything aggressively and everything gets kind of sold off hard, and then it kind of sieves through and starts to differentiate between businesses that have good fundamentals and good operations and those that are really struggling. And we think the market's kind of approaching that period now where it's starting to sift through and differentiate between better run businesses, better valuations and better balance sheets versus the original reaction, which is just to sell everything off.
Just moving on to Blackmores. It's a company we've owned for a long time now, and it's been a frustrating position for us because the company has obviously strong foundations. It's a fantastic brand, not just the Blackmores brand, but bioceuticals as well. They've got strong sales into Asian countries, still have a strong position in China, but also outside of China, they're the number one vitamin player in a number of key markets. And so it's been a real execution issue in terms of cost management at the company. It's not a sales issue for the company, and it was disappointing to have an update from them in early February where they downgraded numbers. Obviously, a new management team's come in, and the pedigree is very good there. We've met with them several times now, and we think they've got their heads around it, and we think going forward, the outlook is very positive in terms of on the cost front and also on the sales front. We think they'll remedy the situation over the next 1 year or two, and they can get margins back to competitor levels. I mean, competitors are generating margins well over 20%, and they're probably inferior products, inferior brands, and inferior positioning. Blackmores in the first half had a single-digit EBIT margin, which is incredible for a company of its calibre to be generating single-digit margins. And looking at the breadth and the scale of the sales line in this business, it is incredible. So they're taking a lot of costs out. I think one thing that people miss on Blackmores is outside of China now, ex-China, the Asian business is now bigger than China. And that Asian business in the first half did sales, I think it was well over $100 million in the first half, and that actually exceeded the full year sales in 2017. So that ex-China business in Asia is growing at 20 to 30% per annum, and we think in the next 2 years it actually could be the biggest engine for the business in terms of sales. So people are missing, they're not seeing through some of the short-term pain and seeing the long-term franchise value in this company. If we go to the next slide, you just see the composition of sales and the change since 2015. And you can see that other Asian line, it's gone from 16 to 23%. And you can see bioceuticals, which I mentioned before, has gone from 12% to 20% of sales. China's also grown quite strongly, but they are having problems getting that next leg of growth in China. And that's something that they're reviewing at the moment, and they may look to enter a joint venture with a party that can actually step them up to the next level in China. So some good things happening at Blackmores. Unfortunately, it's been, I suppose, obfuscated by the cost issues with the business, but we think they've got the right management in place, and we think there's strong returns here going forward potentially.
Yeah, as to Matt's point, they've already announced a $50 million cost-saving program, half of which will be reinvested back in the business via advertising, promotional, and product innovation. All these are very traditional FMCG, fast-moving consumer goods type initiatives, which we believe the current management team have excellent pedigree in, having worked at Procter & Gamble, Coty, Treasury Wines, so a lot of very well-known brands, and they bring across best-of-breed practice, we think, to Blackmores, where finally they've got a license to actually implement some of this stuff. And there's tons of opportunity, we feel, in a stock that's been pretty well oversold.
And if it can get back to 20% margins, this company's worth well over $100. And if it can get back to 30, or if it can get to 30% margins, which Swiss is doing, it could be worth $200. I mean, the upside in this business is significant. The top line sales are growing strongly. They've got a great franchise that we think is completely undervalued at the moment.
Yeah, and the backstop really is if they struggle, Matt, that the brand is incredibly valuable. It's been around for 40 to 50 years. It's been selling through Asia for 30 plus years in many cases as well. So it's got a long history. And as we've seen from other companies like Bellamy's, there's plenty of appetite from foreign corporates, particularly China, to look to acquire these Australian brands with great pedigree, to roll through China with a better distribution partner. So we see multiple ways of winning in this stock. And it is a good long-term cash flow generator as well. So we feel pretty comfortable with the holding there.
Which would be disappointing. I mean, if a Chinese company was to take it over, it would be disappointing at this point in time because we think there's significant upside just from execution. Yeah. But it seems like the risks are skewed to the upside there now that management has rebased the numbers. Just moving on to the outlook for 2020, and we spoke about the coronavirus. What we've seen is indiscriminate selling across the share market. It's hard to compete relatively when everything is selling off, and it's been a very painful and frustrating process for us and for investors. But what we're seeing are definitely pockets of value that are now appearing, and even at the growthier end of the market, we're finding that valuations are looking much more attractive at the growthier end, and we have been cycling or rotating into some of the more growthy type names, which we think are now offering better value. Mm-hmm. We do expect some form of coordinated government stimulus. I think you're going to see global stimulus. I think China's going to get on the front foot with this, and I think that will drive a recovery in the materials sector. There has been a sharp retracement in the oil price, and that is very stimulatory for the consumer. So that's good for everyone. I think at the moment people aren't seeing through the pain and looking at the potential gain that's occurring now. So we think markets will recover. Central banks will continue to ease. That will marginalise cash. People will have to keep deploying cash into assets, and we think the share market will benefit in the long term, and there's opportunities abounding at the moment.
Excellent. Look, thanks, guys, and always great to get your insights, especially when markets have been so volatile, and get your thoughts on reporting season, but also discuss how the coronavirus is impacting investing and opportunities within the small mid-cap space. Look, just a reminder that all attendees have the opportunity to ask questions on your screen. But before we turn to some of those questions, I just want to reiterate, some of the things that we really focus on with Spheria's investment approach, and the fact that they really only focus on investing in companies with strong cash flow, no debt, and strong balance sheets, and that precludes a lot of companies that are really concept businesses which have dominated the market in recent years. It's also important to note the Spheria team are very open-minded with their approach to investing, and that ensures they certainly leave no stone unturned in identifying great opportunities within both growth and value sectors, and the funds really sit as a core allocation. Now, we have had some questions come in. Guys, always some stock-specific questions. What are your thoughts on Macmahon recent earnings compared to others in the market?
Yeah, look, Macmahon's delivered a decent result. One of the issues they do face is they have a lot of capex, which is disguised through leases, and so you need to be careful on the actual cash flow generated by the business. They do have some problematic contracts. Obviously, they seem to have sorted out Telfer, but as you saw today with Newcrest coming out and saying they've got issues at Telfer again, there could be issues again with that contract. Also, the Indonesian business is going through, the contract is going through a weaker patch. So we do get concerned by some of the contract issues they have. There is a lot of competition in that space. We exited Macmahon probably last year, so we did make a lot of money out of it, and we just think there's a bit too much risk around some of the contracts in the business. Plus, they had some board changes, which we thought were quite negative in, Jim Walker, who was the chairman, left, and, we did speak to him after that, and we got some insight on the business. So, yeah, we think there's a few negatives with Macmahon.
Okay, guys, I've got a couple of questions. I'll kind of merge this question in. In a more recessionary environment, typically large cap stocks seem to be safer. Are you guys moving up the market cap spectrum in your allocations at the moment in terms of smalls, micros, or the ops fund?
Probably a little bit in the smalls. So as Matt said, we've noticed some of the growthier names have come off pretty hard. When we find them attractive, we will be looking to buy some of those. So they tend to be slightly at the larger end, but we're not shifting our bias necessarily because of that. It is fair. I think people do tend to go to more liquid names in a tough environment. Names they know and understand. They also tend to flock to businesses that make great cash and have good valuations. So all the speculative stuff tends to get hit pretty badly as well. So we don't, we never trade out in speculative stuff generally because we don't find it meets our basic criteria. So, cash flow, all the basics come to the fore, including liquidity in shares. So we are trying to keep the portfolios liquid. We are looking for good opportunities, but we're sticking to our process. As Matt said, we're still doing company meetings, still having plenty of team discussions, still running our models across the whole sector, and just trying to stay calm and look for good opportunities as opposed to react to the constant news flow we're seeing in all the media channels, which are probably exacerbating the underlying situation.
Guys, obviously topical at the moment. A couple of questions in here on the energy sector and oil. Have you guys got any views, exposures there?
Look, we have a bit of exposure. Unfortunately, with Horizon Oil, it's gone through a bit of its own challenging environment. But we think probably the issues between Saudi and Russia, it doesn't seem rational that would be a long-term issue. Obviously, you've got two things going on. You've got those guys producing more oil short-term to try and jockey for position, and you've got a demand destruction with oil given some impact from coronavirus and lower travel rates, etc. But we'll be looking across the sector. If we find interesting names, we'll be adding to them. We also have derivative exposure to oil too via some of our oil service players and some mining service companies as well, which we've used to top up a little bit into. So,
okay, another stock-specific question we've got in. City Chic reported well. Is it one of the only retail companies to have done well in reporting season in a pretty tough sector?
Well, we're probably misclassifying it as a retail company because a big chunk of its sales now are online. So, over 50% of its sales now come from its online channel, and that will continue to grow. They've bought a position in the US market through Avenue, and they've also been organically growing through the US market, mostly online as well. So you're going to see a healthy increase in their online sales. The business, it's not immune to economic impact. There's going to be some fallout for the company. It does dominate that plus-size female retail market in Australia. The US is a big market. They seem to be getting traction there. We think the acquisition of Avenue does step it up even further, gives them greater scale in that market, and they bought it relatively cheaply. It also gives them a different brand and, I suppose, a distribution into the market. And it also allows them to scale up their current business through that channel as well. So they're already selling one of their key brands through that channel. So we're excited long term about this business. We think it can continue to grow. The management team is fantastic. It's got a great balance sheet. The cash flow is great. and the growth and the addressable market is quite large. So we're pretty excited by this one.
Okay, guys. In volatile markets, just remind me how Spheria's beta looks versus the index and competitors.
Okay, yeah, sure. So beta, obviously, simply put, is the amount the fund wobbles around compared to the market. So if we have a lower beta, it means we move around less than the market, simply put, which I guess is a measure of risk, but not the only measure of risk. But anyway, we typically have a beta of between 0.7 and 0.8 for our funds. So in other words, 20 to 30% less volatile than the market over time. It's not something we necessarily aim for. As you well know, we focus on a lot of fundamentals that we think give us lower beta. So it's more of an outworking of our process as opposed to something we're deliberately trying to do. So we would expect, generally speaking, lower risk and lower vol in our funds. That's certainly the aim, the intention of how we invest.
Excellent, guys. Look, that's all we do have time for today. We have had a lot of questions, as we always do, with regards to Spheria. We will come back to you online. Currently, the Spheria funds are available and positively rated by Lonsec and Zenith, and are available on most wrap platforms. If you are interested in allocating to the Spheria Opportunities Fund, we'd certainly like to hear from you, because we're aiming to get that fund available on platforms as well. We will be making the webinar available on the Spheria investment website, which is www.spheria.com, and that'll be available later today. We'd certainly like to thank everyone for your participation today. If you have any further questions, please refer to the Spheria website or contact one of the Pinnacle distribution team. You can see their details there on your screen. We look forward to catching up with you either at our next webinar, in our office for one of our luncheons, or at in your office for one of our meetings. So thank you very much and have a great day.